Okay, we're going to get started. Good afternoon. Welcome to those of you here in the room and also those of you joining online. I'm Mariah Besharov. I'm Professor of Organizations and Impact at Saïd Business School, and I'm also the Academic Director of the Skoll Centre for Social Entrepreneurship. And I'm really delighted to welcome you all here today for the Insights for Action seminar. Our series, more broadly, explores how researchers and practitioners within and beyond Oxford are using research insights for action. Today, we're going to be focusing on finance and how finance can be used to encourage resilience building and climate adaptation. And today is a somewhat unusual and exciting seminar for us because I am co-moderating with my colleague, Professor Juliana Reinecke. Juliana is a Skoll Centre Fellow and Professor of Management Studies at Saïd Business School. She also serves as the Faculty Director of Sustainability, and she leads the school's Sustainability Community of Interest, which is co-sponsoring today's seminar. So let me hand it over to you, Juliana, to introduce our speakers and kick us off.
Yeah, absolutely. So I'm really delighted to welcome our two speakers today, Julia and Clint. So Julia Mensink is the head of impact at Acumen, where she oversees impact strategy, measurement, and management across initiatives and funds. And she has over 15 years of experience of impact investment in international development, with a focus on social impact and economic development. And she's also a guest faculty here at the Saïd Business School for the Oxford Impact Measurement Program. And you've also been a guest faculty on the GoTo Global Opportunities and Threats Oxford. So welcome back, and
thank you.
Glad to be discussing with you today. And then you have Clint Bartlett, who is a finance and investment consulting to the UNDP, the UN Development Program. And Clint has an extensive background in working across multi-stakeholder projects in both the private sector and third sector domains, and developed in emerging market contexts with a focus on inclusive growth, blended finance, and societal sustainability. His work has included advising some of the largest and most respected global philanthropic foundations, funders, and family offices around impact strategy and investing for resilience. And he's currently supporting the UNDP AFCA program that targets resilience building across 44 projects in 33 countries. Clint is also a collaborator on the GoTo course on the MBA, the EMBA here, and sponsors a number of internships on the MBA and master's dissertations with the Smith School for Environment and Enterprise. So I'm very glad to have you both here united. We've had so many private discussions, so now it's really nice to have this discussion with both of you here. So I think maybe the first question to ask is, we talk about the role of finance in building resilience. What actually is resilience? Can we define what resilience is? So maybe this is kind of a good question to kick off this debate. What do we mean by resilience building, and how is it connected to climate change, climate adaptation? And maybe, Julia, we kick off with you. What does resilience mean for you, for your work at Acumen? Why is it important? How does it relate to practice? Can you explain how you see resilience?
Absolutely. So at Acumen, we aim to solve the problems of poverty and build a world based on dignity. And the way we do that is we use the power of businesses and impact investing. And we use that across the capital spectrum. So finance is our bread and butter, but we always apply it as a means to an end. The end is the people on the ground. And in our case, we focus on those living in poverty. And this year we managed to reach to date, actually, we have reached 548 million people globally. So we do it in different markets. And the way we think about resilience is really how does the impact for the people on the ground what does that look like? Now, of course, when you think about climate change, there is typically three ways in which you can think about impact investing in climate change. The first one tends to be mitigation. How can you avoid more CO2 or greenhouse emissions into the broader world? The second one is adaptation. How can we adapt our current practices? For example, in our case, we tend to have a lot of farmers working with diesel. How can we adapt to a solar solution so that that becomes less polluting and also more reliable for their livelihoods? The third one is what we would consider resilience, which is really how are the people ultimately affected in terms of what is their capacity to absorb shocks? And that is about how can they adapt, absorb, and recover from the shocks that they might face in terms of weather cases. But more broadly, we think resilience is actually about how can people deal with their money. So there's economic resilience. And then there's also the climate resilience where it is related to weather shocks, but there's also social resilience. So in our case, we focus a lot as well on the community aspects, because what we know is that in periods of crisis, whether it's weather related or not, community connections can actually strengthen and help absorb and basically facilitate a life with dignity.
Can you share an example of how finance can build resilience?
Absolutely. Yeah, so as I mentioned, Acumen works across the capital spectrum. So in our venture work, we use what we fundraise with philanthropic capital to try to see how we can support and invest into social entrepreneurs on the ground. Typically, what that looks like is we have a lot of work on energy access and productive use of energy. So what we do in our different regions, we try to see those companies that can support energy access for the low-income communities or help them use solar products or green products to see how their energy use can actually allow them to increase their income or to reduce their costs, which in effect in their pockets maintain more money, or you have more money to absorb when there is a financial shock, whether it's climate related or not. When you go towards a higher scale, we also have some bigger initiatives that are focused on growth phase. So these are companies that might be larger scale. They're actually focusing on working at more than just the sort of local rural approach. And these companies are also focused on how can our capital support their growth, taking into account the adaptation, whether that is already inherent in their product or service, or how can we inspire them to think about incorporating more of the planet and the people angle into their business models. So this is where we have two dedicated programs. For example, we're launching large-scale initiatives in Pakistan, and also we have what's called Hardest to Reach initiative in sub-Saharan Africa, where we're trying to offer energy access to the literally hundreds of millions of people that are currently living without electricity. So we have both our venture focus on social entrepreneurs across different regions of the world, as well as larger scale initiatives where we're trying to work with larger scale companies that are using our capital. So the role of finance can really unlock their potential to grow and do it in a more sustainable way with resilience baked into their offering.
Thanks so much, Julia. Clint, how about your work at UNDP? How does resilience come in there?
I think the definition that you gave is excellent. Anything that I'll say, I'll just add on to that. Another way of considering resilience is at once the ability to respond and to adapt, as well as to transform prior to, as opposed to the prior situation. So if you were in a bad situation to begin with, you don't necessarily want to return back to the bad situation. So there needs to be an element of transformational change in the resilience aspect as well. Resilience is an interesting term, possibly for two reasons. The one kind of self-evident reason is that we all have a definition of what resilience is. You could all describe fairly easily how you understand resilience. So in that sense, it's completely unstandardized. It's completely almost unique to the situation where you are, which makes it quite an interesting topic to discuss because markets don't like unstandardization. The second aspect about resilience, which makes it interesting in our context, is it's possibly a word or a phrase or a concept that puts an equal weight on the upside of something as well as the mitigation of the downside of something. So in many ways in which money flows, most money flows based on the narrative around the upside. If you invest in this asset, you're going to make more money, therefore invest in that way. But embedded in that calculation is the risk of that asset itself. But we often don't talk about that. And resilience focuses us also on the risk side of the asset, or the mitigation of the risk vis-a-vis that asset, as well as the return side. So it could be that the word resilience achieves what we've been struggling to do for decades, or maybe even centuries, which is embed into one concept both the upside of an asset as well as the mitigation of downside that the asset brings about. In terms of our work, so the program that we work with it follows very similar kind of philosophy that Julia was speaking about, this notion that when deploying capital into any market, you have to consider both the sustainability of the asset, as well as the dignity, as well as the societal context in which the asset sits. And our guiding light is the principles of locally led adaptation. So this notion, or this idea that if you're going to invest in, say, the Global South, your point of departure recognizes that there is some kind of inherent value in working from the ground up. So I don't mean ground up or grassroots. Often when you talk to, let me not be unfair, sometimes when you talk to some private sector players, you mention ground up, you mention grassroots, and their eyes just glaze over because they think this is too far from us, it's too small, it's kind of irrelevant. And so we feel exactly the opposite. We feel that the kind of systems in which we operate will only become resilient and are only able to flourish if you have sustained economic energy at the kind of, I don't like this word low, but at the smaller levels of the economy.
Okay, so I'm going to jump in here. We've talked about resilience, and thank you both for sharing what it means. I will admit that for me, as someone who hasn't worked directly in this space, it was a tricky concept to get my head around at first. So this has been helpful in addition to the many conversations that we've all had already today. I want to switch the focus a little bit to talk about the financing side, right? So you guys are bringing finance to the question of resilience, right? And really, there's a field of impact investing that is at play here, right? In which you're working, or at least partly working. And so I want to ask you, when you look out at that field of impact investing as a form of financing, what are the challenges that you're seeing and that you're facing in bringing that financing tool to build resilience?
No, I'm smiling because I take a particularly cynical view when it comes to the necessary constructs that we have created to ensure that money begins to trickle down across the global system. So the work we have I think it's a $16 or $17 million program, of which half is deployed in cash grants to nonprofits across the Global South, 44 countries, 44 projects, 33 countries. Many of these nonprofits have some kind of solution that brings about societal climate resilience that has some kind of revenue generating aspect. So a lot of the technical assistance that we provide is not actually helping them do their projects because they're experts in that. It's rather helping them scale through the accessing of non-grant funding. And the way, or rather the framing or system in which we operate is the non-grant funding comes from impact investing and blended finance. I will just limit the response to the barriers that we face. So the barriers that we face are, I'll mention some of the self-evident ones, and then I'll maybe dig a little bit deeper. So the self-evident ones are the big money sitting at the big funds, the big ticket sizes, not being able to find sufficient projects of that sufficient size, delivering the sufficient return. And of course, that is mirrored by the projects on the ground being plentiful, abundant, and the projects on the ground saying, look, we just can't find any money. We have fantastic projects, we have scalable projects, bankable projects, but we can't find the money. And so that gap on the left-hand side and right-hand side is manifested in what we call the missing middle access to finance. And so it's that gap that we try play directly in. And then just to go one level deeper, it is often these kind of symptoms are often manifested by funding just simply not being available. So, if you go to start a business in, say, Sudan, or let me even be less risky, places like Nigeria or Gambia, it's difficult to actually even access money. And then, of course, if you're at a certain scale or a certain level, and then the second problem is when you are able to access the money, it's very, very, very expensive. And the cost of capital, which we'll probably talk about later, is very high. So you can think of interest rates ranging from 30 or 40% per year up to interest rates of over 100% per year. And I'm not talking about loan sharks. I'm talking about a much more formalized system of lending. So those are the kind of symptoms that we have to deal with.
Okay, great. Julia.
Yeah, I think for us, the challenges we face is it often for us starts with the entrepreneurs on the ground. And they face all sorts of challenges. Like Lynn said, often the capital is either not available or at a huge cost. So this is where impact investors can start to play a role. But the transaction costs of that work, especially when companies are early stage in our venture work, are very high. So there's a lot of actual complexity regarding helping to set up a company at scale that is also impactful in magnifying that actual effect on the people and the planet. So on the plus side, impact investing is booming. It's a massive and very exciting time where we're trying to incorporate impact into the way finance can operate. And that means that the spectrum of impact investing, as well as the depth and the just sheer size of money available, even if it's still a drop compared to mainstream capital, there's still a lot of capital out there. So that also comes with a challenge. It's like, how do you then channel those commitments and willingness for capital to reach impactful opportunities? How can you actually make that happen? And that is often a space where we as so, for example, there are big initiatives when it comes down to resilience and adaptation, big commitments also via multilateral initiatives such as the Green Climate Fund, that they, as well as the bigger DFIs and the bigger mainstream players, require organizations that can absorb capital in the millions, not in the tens of thousands or hundreds of thousands, that in some cases you can't absorb capital on the ground quick enough if you're just a starting enterprise. So this is where we tend to work as Acumen, where we can channel the money that we can have in strategic initiatives that we can then allow for either our energy work, or our agriculture work, or our workforce development work, or our health work in certain markets. How can you then find the right strategies to actually make that the transfer of the money? But in many cases, what we find is that the challenge is it's actually not just the transaction that is the hard work. In fact, the actual investing piece is actually relatively straightforward. Once you do your due diligence and then it's transaction and you monitor and you sort of get on with your investment cycle. Actually, the hard work is how do you find the most impactful companies? How can you source the deals, as well as how do you support the deals to scale? And that is often the space where we find ourselves operate, which is also still requiring additional philanthropy capital. And I think the wider challenge that comes with the big boom is that everybody thinks that you can have the best of all worlds with lots of jazz hands around it. But actually what impact means for one player is different from another. And this is, I feel like, where there's an exciting space, but still requiring a lot more collaboration and work, and also better measurements. And I think in particular for resilience, which is still a relatively new term, how can we not let the sort of the swirl around definitions or framing withhold us from action? Because ultimately, I think it's all about making sure that we operate at speed, but still manifest get the right players and more of the right players who are able to do this work.
Okay, great. So I want to ask you about one particular aspect of this. You didn't mention explicitly, but I think it was certainly behind some of what you were saying, Clint, and maybe both of you, which is this question around risk and how investors should think about risk in the context of impact investing for resilience building, and how perhaps we need to think about it differently.
So I will take off my UNDP hat and speak as a person outside of the UNDP. I think it's only fair to the UNDP. So this is my personal opinion. It's also valuable, I hope, at least, because it derives from other experiences that I've had, not least of which being a native South African and kind of growing up at the end of apartheid and kind of seeing what systemic degradation looks like, what the systemic destruction looks like, and then living through how a system seems to survive that nonetheless, almost from its bootstraps up. I think that, and I'm conscious of the fact that we're in a university, we're in supposedly, and I don't mean that cynically, we're in a place where minds are meant to be challenged, they're meant to be free. So I'm going to say things in that spirit. I think in many ways, the conversation around resilience, around risk, is one that I fear we're not having critically enough. I think that we are running out of time to have the money flow to where it needs to flow. And the kind of evidence around that is, if you look, 10 or 15 or 20 years down the line, you look at countries in the global south, what do they look like when it comes to climate change? What does it look like when it comes to social cohesion and social stability? And if the answers are, well, it looks really bad, I would argue that it's probably not their fault, that there are external factors at play or external trends at play that are making it actually impossible for them to become more resilient. And my argument would be that a large driver of both individual granular asset behavior as well as system behavior is the cost at which it's able to access money. And if the cost is too high, rather the cost is a function of the risk that investors or funders perceive this asset of the risk, then it follows that the cost of the money is going to be too expensive, it's going to be too much. And so if that is true, and I'll end here, then the question is, well, how is the risk assessed? Is it a fair reflection or is it a fair assessment of the risk when you look at a Ugandan coffee farmer and you say, just because she sits in Uganda, therefore her risk premium must be 10 or 12 or 8% higher than any other kind of asset? So I've been doing this for a long time. I'm not for a second making the argument that the Ugandan coffee farmer is risk-free, but what I am making the argument is that the real risk of the Ugandan coffee farmer is somewhere but starting above zero, below to what we assess the risk to be. And that assessment is wrong probably in two ways. The one way is, I'm going to be a little bit more diplomatic here. The one way is, let's just call it ignorance. This idea that, look, I haven't been to Uganda before, I don't know what this person is, but therefore this person is risky. We're going to slap onto this kind of asset a risk premium because we don't know. And that kind of implies that the person somehow is deficient or dishonest or unskilled. And I think in many ways, we see that. We see that where you talk to an investor and they say, we will not invest in Kenya. Just no, forget it. I think then the other aspect, the reason why the risk is potentially overestimated is, I'll probably come to this just now, is that when you have an asset that is doing good stuff, it's creating social outcomes, it's creating social externalities, it's creating cohesion, it's creating resilience, which I would argue a Ugandan coffee farmer has a much better idea of than, say, a New York banker. That social outcome, we don't know how to measure it. And so the good stuff that is occurring, the good consequences that is occurring, the risk that is being reduced as a result of that, because we don't know how to measure that, we are automatically overestimating the risk of that Ugandan coffee farmer.
Okay, thank you. Julia, do these ways of thinking about risk resonate with your work at Acumen, and how do you grapple with them?
Yes, I think in terms of how risk relates to our work, I think risk is important for any investor. So I think the fact that we currently don't have an ability to incorporate the positives of resilience in the wider risk approach, is an area where we can try to improve. Practically, I feel in normally the practices of investing incorporate risk as part of ESG. So this is when you have an investment as part of your due diligence, when you think about investing in a company, you explore what is the risk to this business, the model, as well as this investment in my portfolio. So that's where you start to take you consider environment, social, and governance, and you think about what could possibly go wrong and how can we mitigate that. So you really start at this angle of the negatives and how can we avoid that. That's both then implied for how can we support the company to avoid that, or in some cases it actually leads to a non-investment because you think this is just not risky, this is not suitable for my portfolio. So that then feeds into the risk appetite, and this is where globally, with the hope of investments obviously offering returns, the appetite for risk tends to be very low. And for impact investing, there has to be some recognition for the difficulties that many of the players that we operate with have to work in conditions where, and even countries where the financial infrastructure, the economic infrastructure, in fact, even the physical infrastructure is not optimal for business. So just assuming this global approach of like risk assessment has to be tailored to not only the country and the region, but also to the community and the people on the ground. And in fact, in our case, what we have is a decentralized investment model. So we have investment committees and teams that are on the ground where they source the deals and they engage with the company. So there's a lot of inherent understanding of both the national context as well as the business model and the market in which the companies operate. So that assessment is done closer to the ground. So I think that is that can be a positive. And I think the other element is around how can we transfer the knowledge of what does it take to do this and how can resilience be built. It's typically actually on the positive. So if you think about resilience, building livelihoods, offering people and customers more value for money, or actually value and generating income generating products, that is increasing their resilience. But at the moment, it's taken as a side, as an impact. So I think that is on the impact measurement side. I think part of an idea of can we incorporate that in the wider models, but also it's about how can we lay the positives alongside the ESG and the risk management as part of the decision making, not just in our context, but then how can we translate that to the bigger players or the funders that fund us? How can we offer them that recognition that this is hard work, and it's not just because the returns don't look good doesn't mean that the impact value is on the ground and it's real. It's not captured in your financial returns, but possibly in the way that you would see in the Western world. But that is where I think the challenge lies, but also the opportunity of how can we leverage the measurement that we're doing now, as well as how can we then improve the fuller understanding per deal, as well as the understanding of the regions and what it takes, because these things are not limited to the developing world. These things are just as valid, even in countries like England, where you still have a lot of untapped potential of impact just because it hasn't been seen or framed as investable.
Okay, thank you. Juliana, I want to turn to you, reflecting on what you've heard from Clint and Julia. You do work on impact investing and related fields. How do their approaches and ideas and the challenges they've talked about and the ways of thinking about risk resonate with what you're seeing in your research?
Yeah, I want to come at it from the other side, from the point of view of kind of more mainstream institutional investors. I'm doing some research on pension funds. And I've been engaging with them for a number of years on climate risk. And typically the answer has always been, oh, we have fiduciary duties that mean we have to maximize the returns and also ultimately the returns of people who will draw a pension. So they're kind of inherently competing demands there. But recently, there's a new reporting requirement in the UK that pension funds have to think about the climate risk of their portfolio, of their asset holdings, which potentially brings in a completely new aspect, talking about risk, right? And you can think about pension funds would be the ideal kind of providers of that sort of finance to kind of the global south. They're more long-term oriented, they're more patient. But I would say kind of now for the first time, they're really challenged about what happens to our finance in a world that is threatened by climate change, where resilience, we cannot assume that, but we have to think about global challenges and crises that potentially are of systemic nature, and what is this going to do to our portfolio and our investments in the long term. So now for the very first time, they're kind of thinking about these very systemic questions. But I think there's still kind of this big gap to be bridged between kind of, the world of the pension funds, institutional investors, and then the world of kind of the small and medium enterprises in the global south who need access to finance. And sometimes these kind of gaps, they're kind of these institutional barriers. So if I come to the world of pension funds, they're very heavily regulated for good reasons, but they can only invest in very certain assets and asset classes. So how do you make it fit? That you have kind of, what you talked about ticket sizes, that's a problem, but how do you create an asset class that actually becomes something that from a regulatory point of view actually fits what, for instance, pension funds could invest in? So there are all these kind of barriers we have to think about that kind of make the bridging of these two different worlds really, really difficult. And then on the side of kind of the enterprises, often, I mean, in my research in Bangladesh, but also other countries, there's some challenges that start with creating a bank account, having a credit history. That is all kind of very difficult to then to build up to actually have access to finance. And so they're all kind of these multitude of challenges on both sides that make it really hard to kind of combine these two worlds. And that's why I think kind of this work that you're doing, really working on both sides, from the sides of, okay, we need to work on the ground with the entrepreneurs, but we also need to work on kind of the investment side is really important to bridge this gap. But maybe that's a good segue that I can use to talk about some of the trade-offs that you also see in your work, and kind of the competing demands maybe that we have in that space. You mentioned that earlier, Julia. And there are different objectives, different interests in the system. There are these clashes. So I was just wondering, how do you face these sort of, what are the trade-offs that you face? How do you kind of confront them? How do you manage them? Because there must be tons of them that you have every day in your work. How do you do that?
Yeah, there's lots of tensions in trade-offs, in particular because usually with impact, there's usually a hope for SDGs. This is coming from a development approach. And then you've got the reality of business and actually running your business and of growing, scaling, exploring your product development, your product range, your pivots. And the practices are completely different. So if you now try to marry that, what you find is these sometimes a sense of trade-offs, sometimes real trade-offs. And this is what we face as an organization, as Acumen. So in case when we fundraise, there's a lot of institutional and philanthropic capital out there, but it's usually earmarked for specific areas, whether it's an existing sector or a preference. Usually it's around, for example, health, education outcomes, or income generation, or poverty alleviation, but then it's connected to sectors. So you have to fit a lot of boxes. So there's a lot of dancing around that everybody tends to do around, okay, well, wait, this funder does that, but it should be so aligned with what we're doing. Yes, but now it doesn't. So now how do we both get on the same page and check all your boxes so that we don't end up missing out on this opportunity because it doesn't match what you need in my proposal to be going through for your funding round. And similarly, in our case, what we have is we tend to try to focus on what we call accompaniment. So we like to see ourselves alongside the companies, and we support them by respecting them and starting with where they are and where the world is, and seeing what it is that we can improve, as opposed to imposing now, okay, well, if you have our funding, you also have to do this, and you need to think about child labor and including your women, as well as reaching this new area. And have you thought about what is actually your CO2 emission? And a lot of these companies are not necessarily in the space to absorb all those data demands and sometimes even restrictions, because they're trying to run their business. So there's a lot of that tension. At the same time, I think it can be done. And I think this is where we try to see the way we do it in terms of how we try to manage it at Acumen. We have our dedicated strategies and initiatives. So based on that, we have a blueprint of the kind of companies that are most likely to serve our needs, whether it's meeting a number of, impacting a number of people, whether it's in our agriculture work, for example, which is very relevant for resilience building. We have a couple of elements that we like to see, whether it's nature-based solutions, whether it's climate adaptive innovations, whether it's using the products of the biodegradable elements. So there's a lot of things that can happen within a business model. So there's a couple of things that we then look for. So when we do due diligence, when we select which companies we invest in, we try to make sure that the company maps our strategy. And then within that, we then we can offer technical assistance, and we can offer further support that can help elevate all the other elements. So in that case, for example, in our work, we have what we call a resilience and a climate lens. So this is what we apply across all our portfolio companies. And then we have our initiative that have a dedicated adaptation strategy. So then within that dedicated strategy, each company and each opportunity needs to fulfill a certain number of requirements. And then we can work with them. So there's different layers, but there's a lot of juggling, and there's also a lot of collaboration and making sure that whatever is proposed is practical, doable, and obviously ultimately aiming to magnify the impact that our companies can deliver.
Thanks so much. So it's really about on one hand we need to measure this, but on the other hand not to overwhelm kind of companies or enterprises with kind of these demands. And
it's not just about asking to measure or document, because usually that's a checkbox exercise, and measurement typically has to happen post the event, whereas actually it's also much more proactive, forward-looking. What can be done? What do you currently do? What can you do? Does this resonate? Does it fit into your business model? So then resilience or climate can become an issue that you can think about as a win-win within a business and the social, the positive impact, as opposed to something that you add on top in a restrictive manner that usually doesn't actually resonate with the business model or the operations or even the context in which our companies operate. So it really starts from how can we support and how can we offer opportunities that can magnify both the business operations, the results, as well as the impact, but not from a restrictive pushing, like you have to do all of this, as well as you need to give me lots of data points on stuff that you probably don't have data available, because that sometimes can actually take away from the efforts that we need to magnify the impact.
Thank you. Clint, does this resonate with your experience, or do you have a different?
I'll come back to the win-win now. I think the first thing to say is on the pension funds, that I think often many of the investors that I speak to, and I talk about Global South and Global North, is I realized that my framing, I assume that the other person's framing is the same. So let me just, for clarity's sake, the analogy that the Global North views the Global South, views two bicycles, and that they view the Global North bicycle and they view the Global South bicycle, that's quite obviously wrong. Someone would say, okay, yes, obviously, because they're the same bicycle, it's just two different wheels. But I actually think that's also wrong. I think it's the same wheel. I think that, and I fell into it myself because I started saying stuff like the Global South and the Global North. But so I fell into that trap already. But the point is that there's no such thing as the Global North and the Global South. I'm using it for shorthand to illustrate where the money sits and where the need of the money is. But I worry that many of the funders that I speak to actually see them as two separate and distinct systems. And part of what we're trying to do is we're trying to make the argument that is wrong. It is one system. It's one planet that's utterly interconnected. It's very difficult to make that argument because if you live in a very wealthy city in Dubai or New York, or you know what I mean, a house in London, it's very hard for you to walk out the door and feel the visceral impact of what's happening in Uganda or South Africa or Argentina or Bangladesh. And that makes us fall into the trap to think that it's not impacting us. And the risk is that we only realize it's impacting us when it's too late. So there was an economist, the cover of Economist magazine 2 or 3 weeks ago, there was this picture of the beach house on the shore with a big wave, and it says, climate change is coming for your beach house. And I think that's we need to start seeing that. I was in Dubai a couple of weeks ago. I don't want to sound callous, but luckily it was 3 or 4 days after those massive floods. And it's very, very hard in that context, with that amount of money and wealth, to even talk about this notion of risk, because risk is a very personal thing. We understand somebody else's risk in when something bad happens and it negatively impacts us, but that's very difficult to understand somebody else's resilience in relation to how it positively impacts us. So I want to assert that the Global South and Global North is part of the same system. I think the second thing is then to come back to this issue of the trade-off. So think about a system. Let's just pretend let's call it a local system. And in the system, there's going to, think of it as a square, and maybe think of it as a black background, and then there's white dots. And let the white dots represent, even that, I fell into that trap already, green and yellow dots. So have a yellow dot at the back, let the green dots represent resilience. If you look at that system, in the context of impact investing, blended finance, we look at the private sector to be able to create social outcomes in that system which build resilience across that entire system. That system has societal voids, institutional voids that the government can or will not respond to. Philanthropic capital is not sufficient. And so it all falls, or not it all falls, but it falls to the private sector to do that. That's why we have something called impact investing. That's why we have the SDGs. If we didn't either have faith or believe or have the knowledge that the private sector could bring about a positive social outcome, we wouldn't have this thing called blended finance or impact investing. So the first point is that there is an assumption that we're all working with, that the private brings about a positive social outcome. That horse is bolted, that's gone. We're working with that every day. So then the idea is, okay, when they actually build these social outcomes, is there a cost associated with building the social outcome? So if you are going to change the needle on household income or access to education or access to healthcare, you as the private sector entity, is there a financial cost associated to that? And I argue absolutely yes. So you can go into an income statement, it might not be written like this, but you go into an income statement and you'll be able to parcel out the line item that says, look, the societal void was poor access to healthcare. We spent X amount of dollars to change this thing, but we absorbed that cost. So you have a scenario where you have this asset which is incurring this financial cost to create the social outcome, to build a better picture of the system, to fill in the green dots and the yellow dots. I forgot my analogy. But now you've got this asset which also has to generate a return, not just any return, it's the market return. What is the market return? The market return is the return commensurate with the risk that the investor is taking when investing in this asset. But a couple of minutes ago, I made the argument that the risk assessment of this asset may already be wrong. It might already be wrong because it doesn't know how to account for the positive outcomes brought about by this asset. So the very return against which this asset is measured ignores or is not able to recognize first the lowering of the risk of this asset as a result of its social outcomes. But it may not even be able to realize from the get-go that this asset is far more resilient than what we think it is because of this ignorance aspect. So now you have a scenario where you have an asset, it has to incur the additional cost, and it has to generate, I'm picking the market rate, 15% out of this, it has to generate 15%. And there are assets like that. There are assets that exist in these systems that generate market-based returns, and they create the social outcomes. So those are phenomenal business people. Those are phenomenal assets, and they're phenomenal business people because they can operate in a system of unpredictability, of risk, and generate market-based returns, which ignores the cost to work in that risk and generate social outcomes. As I said before, they should be teaching here. It's not us who need to teach them. So we have a scenario where you have, now to finish, this notion, this is not what you said, this notion of the win-win, this idea that you can both generate a return that is based on a higher risk than you actually are, and at the same time incur the cost to create a social outcome. That for me happens in very, very rare cases. What happens in more cases is that those two are not possible at the same time. The asset then chooses, or is forced to, not create the social outcome because it has to pay back the high cost of capital. And what happens? A vicious circle. It can't create the social outcomes. It becomes more risky. Therefore, the cost of capital increases. It can't create the social outcomes. And we sit in the systems in which we operate today versus a scenario where the cost of capital changes as a function of the social outcomes that you create. The more social outcomes you create, the lower your cost of capital. Not because you're nice companies, not because you're philanthropic or concessional, but because the real risk that you represent is now more accurately measured. And that's ultimately where blended finance needs to go for it not to remain the definition of unsustainable finance. I'll pause there.
Thank you. This is a fascinating discussion, win-win or trade-offs and how to manage them. Luckily, we have Mariah in the room, who is a world expert on exactly that question. So Mariah, can you explain from your academic research, what do we know? I mean, okay, this is I'm opening a huge can of worms here because you have so much research and so much to say about this, so it's impossible to answer in a short time. But in light of what you've heard, what would your perspective be?
Yeah, thank you. So I want to highlight two things from what you both said that resonate with my own work, with a lot of work that's been done on how individuals and organizations and systems can manage what seem to be trade-offs, what sometimes are trade-offs, but sometimes just are seeming trade-offs, and navigate competing demands. And first, Julia, from what you said, so I mean, you started with sort of essentially sort of the impact in the business, right? Or sort of there's the economic imperatives, and then we have to think about the impact, right? And you weren't saying they're always in tension, but there's a risk of seeing it that way, right? And you also talked about, well, we know we need to meet the ventures that we're supporting where they are, but we also want to try to get them to start to think about other things or layer in something else without imposing. But you know, how can you start to bring in some new things that maybe aren't where they are today, right? New lenses, new considerations, and balance those with the capacity and the focus that they have. And so the first thing that I want to highlight is that the very way you frame that matters hugely, right? And so you were talking about the value implicitly of framing it as a both and possibility rather than an either or possibility. And the work that I've done, along with many others, really highlights the value of that both and mindset of thinking about the challenge differently, not saying there aren't trade-offs, but opening yourself up to the possibility of how could we find a way to do both. And the challenge here is that doing both doesn't mean it all mushes together, or they're all the same, or they're not in conflict, but you want to start to think about ways of maybe it's temporally focused here on this first part now, then something else later. Maybe it's in different sets of activities or initiatives, but ways of finding a both and. And Clint, I want to link this to one thing that you said, which is about, you know, you have the global north, global south, right? We're all integrated. We're all part of the same system. And there's this risk often, as you illustrated, that we overly differentiate, right, and categorize, and we academics do this a lot, right, put things in their boxes and the 2x2, and we need, of course, there's differences, and we're part of the same system, right? And so the both and approach invites you to think about both differentiating and separating and distinguishing and integrating without losing those differences. So that's one piece that I would pull out, and I think various things that you've said really resonate with that. The second, and this comes from work that I've done, particularly with social enterprises, is the idea of what I call guardrails. And the notion of guardrails is that when you're facing trade-offs and competing demands, you want to put a stake in the ground, ways of holding yourselves to, and your organizations to the different sides of the issue, right? Or the different demands or the different priorities that you have. Because without those guardrails, and those could be metrics, goals, it could be the other entities and stakeholders that you're tied to, it could be roles, it could be what's on the meeting agenda. Those guardrails are essential so that you don't lose the focus on the different priorities. And so, Clint, just to pick up on what you were talking about the cost, essentially the sort of, you're not, often we don't sort of price in the cost of the impact activities or the resilience building activities, and costing that in can be understood as a guardrail, right? We need to make that visible so that it's apparent, and the benefit visible, right? And those can be guardrails that help us build greater understanding of what it takes to build resilience, where is resilience, and how to think about that alongside the other aspects of both value and risk. So the both and, sort of how we think about things, the both and mindset piece and the guardrails are two really, I think, foundational in this context, but really in a whole host of contexts where organizations and systems face competing demands. I could go on, but I think that's enough for today. And we want to give you all a chance to ask questions. So let me open it up to everyone here in the room and also people joining us online. Questions for any of us here today? Yes.
Yeah, thank you. We're doing a master's at the London School of Economics, Social Innovation and Entrepreneurship. So this is like so amazing and so interesting and very, thought-provoking. I am about to start my dissertation analyzing the ecosystem in Guatemala on social entrepreneurship. And one question that I have based on what you have been speaking about is, okay, sure, we need to find ways to actually measure and really okay, either is guardrails, we put research in place to actually kind of, define certain, things that are concrete with finance and outcomes and all of that, the social outcomes including. But do you think that a lot of, just framing, as you said, I really believe that it can go a long way just by reframing a lot of what is already done. So would you agree that just really maybe creating some sort of literacy in the conventional banking systems or financial sectors, who really improve something in terms of how they approach the local ecosystems? Or do you think that we really just have to actually provide the data and do the real evidence? Because I really feel like just reframing a lot of the risks. Sometimes people in the banking sectors think that risk is not even risk, it's wasteful, right? So just reframing how things are perceived, acknowledging the social outcomes. Do you think that could really bring a different perception in conventional sectors with finance, and investing?
I think both are relevant. We need the framing first before you can measure anything.
Right.
So, and I think because the resilience literature and the measurements are still quite young in terms of the use in finance, I think we need to start with the framing and who's actually doing what that you can measure the result of. And I think that is what is it that you hope to see? What would success look like? So it's really about, you can, the framing, it could be a theory of change, it could be an impact strategy. What does success look like? And having that as a communication with the mainstream players is a good starting point. I don't think it starts with data straight away, because then if people don't know what you're talking about yet, then the data point itself is not enough. I also think it's usually overestimated how much a data point can do. People think, oh, we need to have the numbers because then it's going to change the world. We need more data. It's like, well, actually, no, you need the framing empowered by the data with your message and the meaning. And that actually by itself is quite complicated work. This is actually my day job, so I can go on for this. But so yes, I would agree. Actually, both are needed, but the framing I would argue the framing. Let's get that first, and then you can actually collaborate with getting the data. So you can negotiate, because data is also costly. So it's like, what do we need to know, and which data do we need, and what is already plausible? What can we find with anecdotal data? What is credible, instead of aiming for rigorous evidence that's going to change the world? Because evidence by itself
kind of ecosystem, we are strong allies. So we don't we might maybe disagree on some finer points. I think on this point, I am right in your camp. I think it's a fantastically nuanced question because I would agree that it's both. I think that too little work is done on critically asking about the kind of framing that we have already, the kind of benchmarks that we use. So the market rate is this kind of sacrosanct holy cow that we can't ask, you can't ask it, because most people, I think, would understand my argument being that we shouldn't be chasing market rates. That's not what I'm saying. I'm saying that the market rates need to account for missing information, which is around resilience building. So the minute you have missing information into the market rate, then you can chase market rates till the cows come home. Because then the 8% that Ugandan coffee farmer delivers in a profitable, sustainable, socially enhancing way is the appropriate return for creating the social outcome, and is the return commensurate with the risk that someone takes. So it is the market rate. The problem is that at the moment, because it's not 15%, it's seen as concessional. And so the power that the words have power, but you call an asset concessional and watch the power around that word. Everybody runs for the hills. So the framing of it is absolutely critical. And then, of course, the data is necessary, because we can make the philosophical argument that most of the world, I suppose, decided that slavery is not we don't want that. You can make a hell of a lot of money if you employ slaves, but we decided collectively that's not right. Nowadays, we need data to understand the argument that, sure, it's not slavery in the way it was 100 years ago, 200 years ago, but there's kind of human slavery in your supply chain. So the data shows that you've done well in the framing, but now you actually have to dig a bit deeper.
Thank you.
Hi everyone. Great to talk with you. Mine is, there's a lot of talk about business systems, and my question is, how can we optimize / simplify?
I'm going to repeat the question so that people online can hear. So the question is really about how do you simplify a very complex system with multiple stakeholders with different objectives? I think in a way that acknowledges there are those different objectives, but we need some way of bringing that together.
Nothing in our argument is against this idea of maximizing shareholder value. It's the same, it's analogous to a pension fund resisting investing in the global south because it doesn't meet its fiduciary duty to maximize return for its beneficiaries. Both those, so firstly, the pension fund is wrong, because the pension fund's fiduciary duty, well, okay, I'll make this argument. I would be interested if they argued against it. The pension fund's fiduciary duty is to make sufficient returns such that their beneficiaries can live in a habitable world in 20 or 30 or 40 or 100 years' time. So if they're going to maximize the value and kill the world, for me, they are against their fiduciary duty. It's the same going for maximizing shareholder value. You can maximize shareholder value, you use it as the maximizing function for sure, as long as you recognize the risks you're bringing about to your very shareholders. So it sounds, I don't want to sound flippant because it's a lot more complicated, and that's where your question comes from. And for me, it's got to do with information. It's got to do with almost the previous question. It's got to do with reframing, asking the questions and finding the data. But that doesn't mean that it has to become a source of work for kind of academics sitting somewhere outside of the real world. That's where my cynicism and irritation comes with the private sector. I know it's a wide brush, because many people in the private sector stand on the sidelines saying, we can't find bankable projects, so DFIs and philanthropists, please, can you find us some? That's not going to work. So it behooves everybody in the system, probably most of the private sector, because they have most of the money, to walk, I'm linking to what you said earlier, to lean into this discussion, to walk forward and say, okay, yeah, we see the problem, what can we do? Not stand back and say, well, once the problem is solved and we have billion-dollar investments that are almost infinite that we can deploy our money into, now we'll play. That's not going to work like that. So I hope I've answered the question. To summarize my points, it is the framing, it is the data, it's the hard work that all of us are doing here. I mean, this is hard work. You have to argue, you have to agitate, you have to persuade, and this is what it is about, because we won't have the data tomorrow. We're not going to have the data tomorrow as to what builds resilience. We might have it in 5 years' time if we're lucky, and hopefully 5 years' time is we have enough time left after 5 years' time. But in the interim, we have to fight. We have to argue.
I do want to allow us to continue the conversation, but I'm mindful that we're a bit over time. So here's what I'm going to suggest. I want to thank Clint and Julia, and thank you, Juliana, for moderating. Those of you who are here in Oxford in the room, please stay for a reception and we will have a chance to continue the conversation. And also I invite all of you to join us next month for the next seminar, which is on Friday, June 7th. We're going to be talking about impact measurement and impact monetization, and we're going to be doing it at Kellogg College, which is a partner of the Skoll Centre. So we will be at Kellogg on the 7th, and we'll be having a reception there out in the garden following. So I invite you to join us next month. And for, again, those of you here, please do stay to continue the conversation. Thank you.